Hi everyone. So in this lecture recording, I'll be discussing how to develop an answer for company taxation question. So last week in the physical lecture, we discussed how to write the answer, how to develop the tax computation of individual taxation. And in this recording, I'll be discussing company taxation question. So I have already uploaded the question to the LMS. So you can read, you can download the question before you watch this recording, and you can go through the question with me, right? It's very important to read the full question before you start doing the answer. So I'll be reading out the question. You also can read the question with me. Sand Beach Hotel Private Limited, SBH, operates a hotel business in Waskadwa with the approval of the Ceylon Tourist Board. The extracts of the draft financial statements of the company for the year ended 31st March 2025 are as follows, right? So the date is given 31st March 2025. And then the draft financial statements for revenue, cost of sales, all the values are in thousands, and then the gross profit. And we have other income, distribution cost, admin cost, finance cost. There's no finance cost. And then other expenses. And finally, the profit before taxation. And now you can see in this P&L, draft P&L, notes are given, right? Note number 1, 2, 3, 4. So you can see note number 1, 2, 3, and 4 given. So we'll see what is included in note number 1. It's about other income. You can see rent income. And there's a subnote number given, refer to subnote number 8. That total value is given. So if you go to point 8, there's a breakdown of this rent income. And then you have dividend income. That's another income source, another point number 9. Cash prize awarded by Ceylon Tourist Board, identifying SBH as the best hospitality service provider of the year. And then profit on disposal of minibus, that's the profit. And then another reference to the note. Note number 2, that is distribution cost. So distribution cost includes bad and doubtful debts. Another note is there. Advertising, depreciation. This depreciation is related to the distribution vehicles most of the time because it's coming under distribution cost. And then note number 3, that is for admin expenses, salaries and wages, EPF, ETF, depreciation. Again, why depreciation? This depreciation should be related to administration stuff, maybe admin vehicles, buildings, likewise. Utility expenses are there, and then vehicle maintenance, it says rupees 2.4 million. 2.44 million was spent on cars. Okay, so you have vehicle maintenance 6,000 in total. Out of this 6,000, 2,440, if I remove the 3 zeros, 2,440 was spent on cars. And then you have staff training, a reference is given also, the value is there. Last note number in the P&L, note number 4, that's about other expenses. You can see donations, 2,100 worth of donations, another note. Entertainment expenses, 1,900, another note to a reference. And then provision of lawsuit, annual get-together expenses of the staff. Those are the P&L related notes, 1, 2, 3, 4. And then you can see property, plant and equipment note given. What is included? Lands, buildings, machinery, motor vehicles, cutlery, crockery, and glassware. That's related to hotel industry. And you can see the cost or the valuation. Balance is given as at 31st March 2024. That is the beginning. And then additions or evaluations or disposals, and then the balance. And accumulated depreciation, again, opening balance, depreciation, disposals, and then closing balance, finally the carrying amount of the PP items. And now you can see additional information given. Now, there were so many notes, sub-notes given with references. Now, these notes are elaborated, right? So you can see Roman number 1, 2, 3 like that. There are altogether 11 Roman numbers. So you can see the first one. It says, the composition of buildings as at 31st March 2025 is as follows. Year-end buildings balance. Now you have, if you take buildings, you have 550 worth of buildings, isn't it? So here you can see from this small table, cost 400 and 150,000. So 400 is the opening balance. There has been an old building, that is this. And then there's a new addition coming, 150,000. This is 150,000. So it says, Vaskaduva building and Hikkaduva building. Vaskaduva, the purpose of this Vaskaduva building is the hotel premises. So they might be conducting their hotel activities in the Vaskaduva building. And the cost is given. This is the old building, and the date, construction or the purchase date is given. 1st July 2020 constructed. Then you have Hikkaduva, new building. That the purpose of this new building is rented on 1st January 2025. That means from how many months applicable for this rent? January, February and March, right? 3 months rented this building. 150,000 that is newly acquired during the period. Yes, the purchase date is 1st April 2024. That means, as you can see the dates, you can understand the year is 1st April 2024 to 31st March 2025. So you can understand that. So here, newly purchased on the first day of the year, 150,000. And it says, all machinery as at 31st March 2024 were purchased after 1st January 2021, except one machine which was purchased in the year 2017 at a cost of 10 million. So if we take 1st January 2021, what are the years applicable here? Like the year of assessments coming for 1st January 2021, that means 2021, 21-22, 22-23, 3-4-4-5. Likewise, 5 years. But this 10 million worth of 2017 purchased machine, how many years? 2017 gone, 18, 19, 20, 21, 22, 23, 24, like almost more than 8 years. Why is this? Now, can you claim capital allowance more than if it is more than 5 years? No, right? You can divide the cost by 5 to claim the capital allowance. So that's why it says this machine is 10 million worth of machine is very old, purchased in 2017. Others are within the 5 years range. And then the details of the motor vehicles are as follows. You can see there are motor vehicles, cars, lorries, minibus, and a van. These are the types. And the acquisition date is given. Cars, 1st April 2021. Cost is there. And the purpose for the use of directors. Lorries, 30th September 2021, 11,000 for transportation of food items required for the kitchen. Business purpose. Minibus, there's a star mark as well, strict mark. 1st October 2022, they have purchased 9,000 worth of minibus. That is for tourist transportation. And then that star mark is explained here. The minibus was sold on 31st December 2024. That means within the year, this minibus has been sold. When there's 1st October 2024, 15,000 worth of van for tourist transportation, right? This is how they have purchased these things. All cutlery, crockery, and glassware have been purchased on 10th February 2023. Right. So those are the first 4 points. You can see from the points Those points are related to PPE. And then it says point number 5, the composition of bad and doubtful debts is as follows. Now you can see bad and doubtful debts, refer point number 4. The reference is given. This is the reference. See, the breakdown is given. Trade debts written off, staff loan written off, general provision for doubtful debts, right? Written off values and the general provision numbers are there. And then staff training expenses represent the expenses incurred on a hospitality management training followed by the front office staff during a year. Staff training has been spent on hospitality management training. Point number 7, the composition of the entertainment expenses is as follows. Now, if you see the entertainment expenses, where's entertainment? See, entertainment expenses, you can see the reference note. Refer point number 7. This is it. 1.4 million rupees incurred on facilities provided in the hotel for the guest entertainment, music and other. And then 500,000 rupees spent on a tour arranged to entertain the selected team in the catering division of the hotel. There are 2 types. And then point number 8, the composition of rent income is as follows. It says, a part of the hotel premises has been given on rent since 1st April 2024 to a shopping arcade at a monthly gross rent of 200,000 rupees to provide facilities to tourists. Now, this is very important. Now, part of the hotel premises means which building? Waskadua building or Hikkadua building? Waskadua building. A part of this building has been given on rent since the beginning of this year of assessment to a shopping arcade. Now think whether the giving on rent part of this building, giving on rent to a shopping arcade to provide facilities to tourists, is this effectively connected to the business or not? Think about it. And then the company has accounted for this rent income properly. And again it says SBH, the company, has rented out its new building in Hikkadua, newly purchased building, for a monthly gross rent of 200,000 for an office space of an educational institute with effect from 1st January 2025. So the how many relevant months are there? 3 months. It was the same with this table as well, isn't it? Rented on 1st January 2025. That means for 3 months it has been given on rent, but for an educational institute's office space. And within bracket it says, this business was kept. This should be this building. This building was kept vacant since the date of the purchase to 31st December 2024. That means until they rent out their newly purchased building, that building was kept on vacant. That means it has been not used for hotel businesses. It was just vacant, right? Those points will be important for us. And then the composition of the dividend income. So you can see coming under other income, dividend income, there's a point, refer now point number 9. So this is point number 9. Dividends paid by Sakura PLC. We have received dividends from Sakura PLC out of the profits of Sakura PLC. Sakura PLC has paid us dividend income out of the profits they have earned, 330. And then another dividend paid by Legrand Hotels Limited, a resident company. Again, we have received dividend income from Legrand Hotels, which is a resident company, out of the dividends received from another resident company. Legrand Hotel has received dividend from another hotel company, resident company, and then out of that dividend income, some amount has been paid to our company. So that's why it says out of the dividends received from another resident company. And then the last, before the last, the composition of donations is as follows. Now it says donations, refer point number 10. It says goods donations to the Fritz Row Children's Home and approved charity. There's a goods donation to an approved charity. Donation of school bags to children in Lunagama Government School. Okay, it's a donation of school bags in kind to Lunagama Government School. And then cash donations to HelpAge Sri Lanka. Now, HelpAge is one very famous approved charity that you need to remember. That's why we have not mentioned whether it is an approved charity. But if you see Fritz Row, you won't know whether it is an approved charity. That's why we have given. But HelpAge is very famous. So it's a cash donation to an approved charity. Last one, cash donation to the Ministry of Tourism. And the last point, it says income tax paid by SBH on self-assessment basis for the year of assessment 24-25 was 5.5 million. Self-assessment payment was also given. What is required? Calculate the balance income tax liability of Sand Beach Hotel Private Limited for the year of assessment 24-25. You are required to show all workings. Right. 30 marks question. This is how you get a company taxation question. One way of getting a company taxation question. Right. So we'll discuss the answer now. Now, for my reference, for my purposes, for my easiness actually, I have the format with me. It's like this, isn't it? So as I told you last week, you have to write the company name, and then income tax computation for the year of assessment 24-25. Now, first of all, what I do usually when I have a question like this, I draw the format and then it's very easy to fill in the blanks. I keep excessive space. That's okay. That's okay to have excess space when you are doing the end semester exam as well, rather than running out of space, right? Okay. So I am writing the important things. Now, when we do an individual income taxation, what are the income sources available? Starting with employment income, business income, other income, and investment income. But when it comes to a company, there has no employment income. You can have maximum 3 income sources: business income, investment income, and other income. So I have written number 1, business income. Business income. That means coming from the company. And then I have written investment income. That is a second source. And the third source I didn't see, but I have written other income. Here, since I know that there are no other income sources, I have not kept space, but you can keep some space. And now you know for business income, you need more space. More space. And then after that, I write the total of all these income sources, assessable income. And then from that assessable income, you deduct the qualifying payments. We discussed this last week, qualifying payments. When you deduct the qualifying payments from the assessable income, you have the taxable income. And using the taxable income, you calculate the tax liability. From that, you deduct your tax credits available. And then you can have your final answer, balance income tax payable. This is the same with the income tax question as well, income tax calculation as well, but employment income is there additionally when it comes to the structure. Right, now we'll start. Now, first of all, when I take the business income, remember, one easy way of getting that is, I will be adjusting the profit before tax number. So I have written profit before tax first, coming under business income. Profit before tax, how much? 66,515. 66,515. Right. That is the profit before tax. And then I told you that I'm going to adjust this profit before tax amount. So I'll be adding some components and I'll be deducting some components, adding or deducting. when and where necessary. Right. So I'll be taking these numbers from the notes, Ramay. Starting from the notes. There's no one particular point to start this question. You can start from wherever you want, but I'll be taking the notes. Note by note, I'll be doing the adjustments. Note number one, other income. Coming under that, the first one is the rent income. Right, rent income. So you have 3,480 rent income. Reference note is number 8. So I'll be going to point number 8. Okay. This is the part, rent income. We'll read the rent income. Now we have read already. Now we know part of the hotel premises has been given on rent since 1st April. So I told you Vaskadua buildings, one part has been given on rent to a shopping arcade to facilitate the tourist. So in that case, even though you have rented out your building, part of your main building, that income, this is rent income, no? Rent income, that means 240,000 monthly multiplied by 12, you get the whole rent income for the year. Is this rent income or business income? What do you think? Is this rent income or business income? Ideally, this is business income. We do not consider this as an rent income because this rent income is effectively connected to the business because it is a shopping arcade and to provide facilities of tourists. So, can you keep it under business income? 240,000 multiplied by 12. Can you keep it as can you keep it under business income, profit before tax? Yes, of course, you can keep it like that. No need to change anything. No pluses or minuses. But now can you remember when you have rent income, you have to deal with WHT, withholding taxes. So we discussed that last week as well in detail. I told you when you have rented out one of your buildings, if the tenant is paying more than 100,000 rupees monthly rent income, now in this case 240,000 rupees monthly, that tenant should deduct 10% of the rent income and remit that 10% to the Inland Revenue Department, and balance 90% will be paid to the that means the owner of the building. Is that clear? 10% should be deducted if the monthly gross rent is higher than 100,000 or equal to 100,000. I told you if the tenant is an individual, that is exempt, that is not applicable. Now, in this case, what do you think? It's true that we consider this rent income as a business income, but when it comes to WHT, this tenant should deduct 240,000 multiplied by 12, that total income, 10% of it as the withholding tax. So that means we have already paid withholding tax, that amount. So we'll write that amount where? Where do we record that? Deducted WHTs, tax credits. So we can write AIT, advance income tax on rent income. What is this? For shopping arcade, no? We have multiple rent income, so it is better to write those things. For shopping arcade, how much we have paid already? I mean, tenant has deducted from us. 240 multiplied by, I'm doing without zeros, 12. That would be the rent income. Multiplied by 0.1. That means 10%. 288,000 has been deducted by the tenant as the withholding tax. So that is the adjustment for this one. Right? I'll be taking like this. And then the second one, it says that newly purchased building from Hikkaduwa that was vacant from the date of the purchase till 1st January 2025. From that onwards, this building has been given on rent to a educational institute. Now, do you think this is effectively connected to the business or purely rent income? This is not effectively connected to the business because it is an educational institute. So this is a rent income. Rent income. How much is the rent income? 20,000 gross rent income, 200,000 gross in rent income multiplied by how many months? 3 months. Only 3 months. So 600,000 rent income has been recorded under profit before tax now. Now, can we keep it under profit before tax? Can you keep that 600,000 in this profit before tax? Or should we take that 600,000 to investment income? You have to, right? So in that case, I deduct rent income, Hikkaduva building. How much? 200,000 multiplied by 3, 600,000. And then I go to investment income. I write rent income, Hikkaduva. How much? 600,000. 600,000. So I removed the rent income from business income and then added to investment income. That rent income as an investment income. Again, WHT story is coming. It says, if the tenant is paying more than 100,000 monthly. Yes, of course, tenant is paying 200,000. That means the tenant has to deduct WHT when paying. How much? So I'll go to tax credit area. Tax credit area. I write here AIT on rent income. AIT on rent income for what? Hikkaduva for clear purpose educational institute. How much? 200,000 monthly multiplied by 3 months multiplied by 0.1. That means 10%. 60,000 has been deducted. So these are tax credits for rent income. So these are the adjustments for rent. That's done. Okay, that is done. So that is about this rent income. Likewise, you also can cut down, mark those done areas. And then you have dividend income, point number 9, 455 dividend income. Where's point number 9? See here, point number 9, dividend income. Now, dividend income means business income or investment income. Dividend income means business income or investment income. Investment income. But it has been recorded as other income, right? Other income. It is in the profit before tax coming under other income. In that case, should we keep that under business income or should we remove that from here and take it under investment income? Second one, right? We have to remove it from here. Removing means deducting. Removing means deducting. Dividend income. How much is the total of dividend incomes? 455. 455. And I go to investment income and then I can add, right? Coming under investment income, I can add. So what is the composition of dividend income? Dividends paid by Sakura PLC, right? Dividends paid by Sakura PLC. What? Out of the profits of Sakura PLC. What do you think? Sakura PLC's profits were used and paid dividends. In that case, when a resident company is paying dividends from the profits earned, in that case, that company, before they give your dividend, before they pay the dividend, that company is deducting WHT. And that deducted WHT is final WHT. Final WHT means you are not taking or considering that income again, that is final. You are not taxing that again or claiming tax credits. That is final. So in that case, this is final WHT, final WHT. So you are not taking any amount here. Second one, dividends paid by Legrand from dividends received from another resident company. So dividend paid by Legrand, that is from another company, from another company. In that case, you have learned when a resident company is paying dividends from a dividends received from another company, that is exempt. That is exempt. So that's why you are not taking any amount here again. That is about the dividends. So you have removed dividends from business income and then considered or not, you have written, you have considered and you have put the correct amount in the investment income. Right. Going back to the notes. So dividend income is also done. Here, the third one. Cash prize awarded by Ceylon Tourist Board, identifying the company as the best hospitality service provider. What do you think? Is this taxable? Yes, this is taxable. Taxable benefit. You have received a benefit which is taxable. You can keep it under. Anyway, this is coming under profit before tax. No, profit before tax. But you can keep it there as a business income. No need to change anything. And the next one, profit on disposal of minibus. All right. Accounting profit. What is this profit, Lamai? Accounting profit, because this is about the P&L draft. Coming under other income, they have an accounting profit of 850,000 for the minibus disposal. Now, can we consider these profits as taxable income sources? No, right? You have to remove the accounting profit from the business income and you need to calculate balancing allowance. Balancing allowance. So now this has been deducted, this has been added as other income 850. This is included there. So I'm going to remove that first. I'll be removing that. Profit on disposal of minibus. How much is the profit? 850. First, I remove that 850. 850. And then, even though I remove the accounting profit, I need to calculate the tax profits on taxation. That means we call balancing allowance. So now I need a working for that balancing allowance. Working one, balancing allowance calculation. Balancing allowance calculation. Right. Now, first of all, in order to calculate the balancing allowance, so in all the disposal profit on taxation, first of all, we need to know the sales proceeds you have earned, right? You have earned from selling this minibus, sales proceeds. How do we calculate the sales proceeds? Now look at the question. Minibus, after selling the minibus, you have earned a profit of 850. Now, if you go to the PPE note, coming under, it's a minibus, that means coming under motor vehicles, there's a withdrawal or the disposal, 9,000 is the cost. What about the accumulated depreciation coming under disposal? 4,050. What is the accounting carrying amount? Accounting carrying amount. 9,000 minus 4,050, which is 4,950. That is the carrying amount. But there's a profit by selling this minibus. There's a profit by disposing this minibus. How much is that? 850. That means what is the actual sales proceed they have received? 5,800. So that's how you take the sales proceeds amount, 5,800, right? 5,800. Okay, now we'll calculate tax written down value. Tax written down value. That means carrying amount, carrying value of the PPE item when it comes to taxation. In taxation, what is the carrying amount? Tax written down value. For that, I take the cost first. How much is the cost? Cost doesn't change whether it is accounting or taxation, 9,000. 9,000. How to calculate the carrying amount as per taxation? Take the cost and you have to deduct, that means less, accumulated balancing allowance. Accumulated balancing allowance. That means up to this point, how much they have claimed as capital allowance. That means in other terms and in accounting, accumulated depreciation as per taxation. So accumulated capital allowances. For how many years have they claimed taxation? What is the purchase date of this minibus? 1st October 2022. So that means 22, 23, 23, 24, 24, 25. Can we take 24, 25? No. When the PPE is disposed, that disposal year is not considered for capital allowances. That means only 2 years they have used. So for 2 years means 9,000 divided by 5, that is 20% is the capital allowance for 5 years. 2 years, you multiply by 2, 3,600. This should be minus. 3,600 minus. So how much is tax written down value? It should be 5,400. 5,400. Now the tax when it comes to taxation, the carrying amount is only 5,400. But now how much is the sales proceed? 5,800. In that case, how much is the gain as per taxation? 5,800 minus 5,400, 400 rupees. This is the taxation gain. Taxation wise gain 400. You call it balancing allowance. Now, you have removed the accounting profit 850 and you are adding the balancing allowance. Taxation profit on disposal 400. All right. And you can always mention the working number as well, working one. Right, like this. So you have considered the minibus issue here from here. So we are done with other income with that. We have considered all the notes. Distribution cost, you have bad and doubtful debts, refer note number 5. Go to note number 5. Okay. Composition of the bad debts. You have trade debts written off, staff loan written off, and general provision of doubtful debts. Basically, in taxation, general provisions for doubtful debts are not allowed to deduct. Those are general provisions. And also, staff loan written off value is also not allowed to deduct because it is not effectively connected to the business that is about staff loans. Only trade debts written off is allowed to deduct. That is true written off values. So in that case, this is allowed to deduct. 500 is allowed. This 145 is not allowed to deduct. So I am adding them back. General provision for doubtful debts and staff loan written off. Both are not allowed to deduct 145. All right. So that is again done. And then you have advertising. Advertising is allowed to deduct. That's okay. What about depreciation? Now I told you this depreciation is related to distribution. Is this accounting depreciation? No. Taxable depreciation? That means capital allowance. This is accounting depreciation. Can we deduct accounting depreciation? No. We have to add back depreciation, accounting depreciation, and we can deduct the relevant capital allowance. That means you have to calculate depreciation in terms of taxation, capital allowance. So this is not allowed 10,500. But I'll keep it like that in red. And then you have administration expenses, salaries and wages allowed, EPF, ETF allowed. Right. Now you have depreciation again. What is this depreciation? Admin purpose depreciation. Now, if you go to PPE, this is very important when you find the correct depreciation amount. If you go to PPE, you can see coming under accumulated depreciation section, coming under depreciation row, during the period depreciation has been calculated and given for asset type wise. 21,875, 12,000, 10,500, and 6,000. When you add these together, total should equal to 50,375. 50,375, which is higher than the combination of just 10,500 and 33,875. Why is that? The combination of this depreciation and this depreciation is lower than the depreciation they have mentioned in the PPE. Because this is the total depreciation. But here, this is only the distribution and admin related depreciation. What about depreciation of machineries used in the factory? Right? Those are manufacturing overheads. So those might be in the cost of sales figure coming under manufacturing cost. So those are not captured in these two figures. So that's why we have to take the depreciation from the PPE note covering admin depreciation, distribution related depreciation, and also manufacturing overheads depreciation. So that's why I am taking the total of all four numbers as the depreciation. So what do I have to do? Accounting depreciation should be added back. 50,375. I have added back and I have to deduct what? I have to deduct the capital allowance. So I'm writing capital allowance. Since I'll be putting a working, obviously, I'll be writing working number 2. So I go to workings. Working 2. Capital allowances. Right, now we can calculate the capital allowances. Let's go to the question. PPE. First of all, I'll be taking the buildings. Buildings. Now, can you claim capital allowances for Vaskadua building? Vaskadua building, can you claim? Yes, of course, it was used for business purpose, effectively connected to the business. So even though it has been rented out, normally when it is rented out, we are not claiming capital allowances. But even though it is rented out, it is business purpose, effectively connected to the business. In that case, you can fully claim capital allowances. 400,000 is the cost. I'll be writing the cost here. 400,000 is the cost. So how much is the capital allowance? You can divide 400,000 by 8,000. Sorry. 400,000 by 20. If it is a building, you divide by 20, right? 20. You have 20,000, 20 years. That means the capital allowance is 20,000. And then you have what? Hikkadua, right? Hikkadua building. Now, what do you think? Can we claim capital allowances for Hikkadua building? No, because since the purchase date, it was vacant. It was not used for businesses. So in that case, you can't claim capital allowances. And from 1st January 2025, it has been given on rent, which is not effectively connected to the business as well. So you can't claim capital allowances fully for Hikkadua building. 0. And then I'm going to, now the buildings are done. Buildings are done. Now I'm moving to machinery. Now when it comes to machinery, there are two types of machinery. How much is the total value of machinery? Total value of machinery 70,000 cost. 70,000. Out of this 70,000, if you can remember, 10 million, that means 10,000 machineries are old. 2017 purchase means have they fully claimed capital allowances for 5 years? Yes, of course. 5 years gone. So can you claim capital allowances again for this 10 million old machine, which is 10,000 minus 10,000? Can you claim capital allowances for this? No, you can't. It's over. We have claimed fully. So what is the balance part then? Balance part. Now, because balance machines were obtained after 1st January 2021. That means you can still claim capital allowances. 5 years are not completed. So in that case, balance is 60,000. Balance is 60,000. For this 60,000, you can divide this by 5. 12,000 is the capital allowance. This is also done. Moving on to the motor vehicles. Now you can see there are 4 types of motor vehicles. I'm writing motor vehicles. Cars, lorries, minibus and van. So I'm writing cars, lorries, minibus and the van. Cars cost 24, 11, 9, 15. I'm writing them 24, 11, 9, 15. Now can you claim capital allowances for this column cars? Those are used by directors. No capital allowances. Why? Used by directors. You can't claim capital allowance. Lorries. Can you claim capital allowances? Yes, of course. That is for business purpose. Purchase date, acquisition date is also within 5 years, not fully claimed. So you can take 11,000 divided by 5, 2,200. Can you claim capital allowances for minibus? No, you can't. Why? It is disposed. In the disposal year, you can't claim capital allowances. Van. Can you claim capital allowances? Yes, it is for tourist transportation. 15,000 divided by 5, 3,000, you can claim capital allowances. So like this, motor vehicles are also done. And then you have cutlery, crockery, and glassware. It's straightforward. It says those are purchased on 10th February 2023. That means still we can claim capital allowances because you have more years in the 5 years range. So you can take the cost, total cost together. Total cost is 20,000. 20,000 is the total cost. So if you divide this 20,000 by 5, 4,000, that is the capital allowance. Right. So in that case, have we taken lands? We don't claim capital allowance. Buildings, machinery, motor vehicles, cutlery. We have taken all 4 categories. So I'm taking the total of these capital allowances, which is 41,200. 41,200. So we added back the accounting depreciation and then we are deducting the capital allowance tax depreciation, which is 41,200. I'm linking. Right. Like this. Okay. Now that point is also done. Depreciation we considered. We considered now salaries and all depreciation considered. Utility expenses that is allowed to deduct electricity, water and everything that is allowable. And then moving to vehicle maintenance, total cost is 6,000, but 2,440 was spent on cars. This 2,440 you can't claim You can't deduct because that was spent on cars. Cars are used by directors. So you have already deducted 6,000 as the vehicle maintenance. From this, 2,440 is not allowed to deduct. So you are adding it back, vehicle maintenance. How much is that? 2,440. That is also done. And then we have staff training. Look at the point number 6, staff training. This is also done. Staff training expense represent the expenses incurred on a hospitality management training followed by the front office staff during the year. So this is allowed to deduct. This is specifically connected to the business and it is allowed. Allowed means you can deduct. This has been already deducted from the profit before tax. So no need to adjust. No adjustment needed. Other expenses coming under that, you have donations. Now, as students, you have learned donations. You know it's coming under qualifying payments. We'll wait until we fill all the other items. Then you can take it clearly. I will take it as read here. And then you have entertainment expenses, point number 7. See. 1.4 million incurred on facilities provided in the hotel for the guest entertainment. That is for the business purpose directly, 1.4. So is it allowed to deduct or not? Generally, we say entertainment expenses are not allowed. But here, as a hotel, it is mandatory. It's essential. So 1.4 million is allowed to deduct with the nature of the business. But look at this 500,000 spent on a tour arranged to entertain the selected team in the catering division of the hotel. Not for all the members of the catering division as well. Some selected parties, they have gone on a tour. This 500,000 is not allowed to deduct. So that's why you are adding it back, entertainment. Staff tour, 500,000. That is not allowed to deduct. Okay, you are adding it back. So you have considered this entertainment part as well. Right. And then you have a provision of lawsuit. Provision. Can you deduct provisions in taxation? Not allowed. So I'm adding it back. Provision of lawsuit. How much is that? 100. 100. Last one, annual get-together expenses of the staff. Annual get-together expenses. Those are kind of expenses are not allowed. Again, it's like entertainment, not allowed. So I'm adding it back. Annual get-together expenses, 900,000. Right? 900,000. I added it back. So that is also done. All right. Now, as you can see, we have considered everything apart from donations. PP note also we considered. Here, all the points are there. Okay, done. And then only the donations breakdown. Right. So we have another one. Income tax paid self-assessment base. Okay, what is this? When you have self-assessment base payments, what is this? This is again a tax credit. You can reduce your tax liability because we have already assessed and self-payments were done. 5.5 million means 5,500 you have paid. So shall we write that as well before you forget? That's the importance of having the format at once, right? You are filling the blanks. Self-assessment. Self-assessment payments, you write 5,500. Okay, that's also done. And then we have donations. Now, you know that donation should be separately taken as qualifying payments. Qualifying payments. Now, if you are deducting donations as qualifying payments here, now in the profit before tax, accounting profit before tax, this has been already deducted. No? So, since you are taking it under qualifying payments, first of all, you need to add back your donations. You need to add back your donations first of all. How much is the total of donations? That is equal to 2,100. So I'm adding the donations first of all. Then you can consider the donations under qualifying payments, right? We'll see how you do it. Okay. Now, first of all, since you know when it comes to qualifying payments, if it is an individual, you take what? You have to consider whether it is an approved charity or a government institute, government related institute. If it is an approved charity, if it is an individual, 1/3 of the assessable income. If it is a company, 1/5 of the assessable income. You have to compare with the minimum threshold values. Likewise, you have to compare. And when it comes to government, you have to take them separately. So likewise, before that, since we need the assessable income for qualifying payment computations to check whether it is 1/3 or 1/5, we'll finish these areas and come. Right now, we can do this now. We can calculate assessable income. So you add 56,960 to the profit before tax, and you deduct 43,105 from the profit before tax, and then you have the business income like this. See whether you get the same answer. It's 80,370. Okay. And then investment income. What is the total of investment income? It's only 600,000. 600. Do we have any other income? No, we didn't have. Even though we didn't have, I wrote whether we have or not. So the accessible income includes business income plus investment income plus other income. Total accessible income 80,970. 80,970 is the accessible income. All right, now we have the accessible income as well. Now we are going to write the qualifying payments. We'll take first one. Goods donation to an approved charity. What do you think? So I'm writing goods donation. Goods donation to approved charity. It's not allowed. Not allowed because goods donations are not allowed to deduct. Donations to school bags to children in Lunugama Government School. It's a government-related institute. That's why Lunugama Government School is there. It is, even though it is on school bags, it is okay. 100% you can claim. How much is that? 600,000. 600. $600 you can deduct. 100% you can deduct. Cash donations to Help Age Sri Lanka. What about this? Help Age Sri Lanka, I told you it is an approved charity. Cash donations are allowed coming under the threshold. So I can write, first I write cash donations to approved charity. That is 300, right? 300. We'll see. We have to compare and see. No, but for now, we'll write. Last one, cash donations to the Ministry of Tourism. Again, it's related to the government. That is, the value is 1,000. Fully deductible. Okay. Now, these two are full deductible. That's okay. 1,600. But When we take cash donations to approved child 300, we have to compare. What is the first one? 1/5 of the assessable income. How much is that? 1/5 of assessable income divided by 5. 16,194. What is the minimum level? What is the minimum level? 500,000. So I write 500,000. From this, what is lower? From these two, what is lower? 50,000. Sorry, 500,000, isn't it? And then I take the actual. How much is the actual? 300. This 300. So from these two, what is the lowest? From these two, what is the lowest? Obviously, 300. So that amount would be 300. That will be taken here. All right. This is how you get the qualifying payments. Okay, now you have taxable income. You have calculated the qualifying payments. Now we'll write taxable income. Taxable income. You take your assessable income and you deduct your qualifying payments. Total is 79,070. Okay, that is your taxable income. How do we calculate the tax liability now? We have the taxable income. So we take the taxable income 79,070 taxable income. What is the rate? Income tax rate for companies? 30%. So in that case, if I multiply 79,070 by 30%, that is 23,721. That is the tax liability. Tax liability. That is, you are liable to pay 23,721. However, you have already made some payments like 280 WHT, 60 WHT, 5,500 WHT, likewise. What is the total of these things? You have already paid 5,848. So in that case, 23,721 minus 5,848, 17,873 is the balance tax payable. Balance tax payable. And that is the answer. So this is how you basically do a company taxation question. First of all, make sure you read the question fully. Otherwise, you won't find the you won't find all the necessary adjustments. So read the question fully first. Jot down the important points or underline, highlight the important things. Years, dates, very special. Rent, also dates. And then draw the format. You know the format for individual taxation and company taxation now. Draw the format and do all the adjustments at once. If it is rent income, removing the rent income from business income, adding it on the investment income, and then calculating the WHT and putting it as tax credits, all the adjustments you have to do at once. If not, you will miss those adjustments. That's how you can deal with a company taxation question. So it's better to have the format with sufficient space. You will identify that space when you do more questions. When you practice, you will understand, okay, for business income, I need this much of space. It's okay to have excess space. And then business income, investment income, other income, like that. Likewise, do the workings clearly. So even though the numbers are wrong at the end, maybe due to some careless mistakes, if the workings are there, you will get some marks. So don't lose those marks in the exam. Do well with this company taxation question. Right. With that, I'm winding up the session. Thank you very much.